Hello, Business 635, Managing Financial Resources students. This is my week 2 video. This is Professor Hasse speaking live and in color from Claremont, California. Our week 2 update video this week is just to do one final review looking at a couple of problems from our textbook. A review in regards to our basic fundamentals of capital financing, stocks, bonds, the valuation of capital, and the concept of future and present value. So I'm going to spend a little bit of time on that today, getting ready for our week 3 next week when we start looking at financial statements. You have a discussion post this week where you are asked to determine and select an asset and determine its value. Now that asset could be a mortgage, it could be a bank account, savings account, it could be a mutual fund, it could be a stock, it could be a bond, it could be anything. And I just would like you very simply to just explain what the asset is, how you would find its value, and also how you would determine its future value or present value or any other way that you could determine that into the future. And so just an example, nothing fancy. Some of our students are getting a little bit too wrapped up in this and making a big deal of it. I just want you to determine your basic asset type of investment and determine its value in the market. So be that as it may, let's take a look at a couple of problems this week. Before I get going, let me also mention that this video is also going to be posted to my other Business 635 account, or class, excuse me, which is located in Irvine, California at our Orange County campus. And this video is also going to be supplied to that course or class so they could review the material. So I've selected a couple of problems from our text and highlighting the work. And even if you don't have a text, it's no big deal. You can just follow along with the Excel. And this video is to describe the basic fundamentals of capital costing valuation. Here's a problem from, and this Excel spreadsheet is attached to this video this week. Here's a problem from chapter 4, page 185, where I give you the determine the present and future value of $500. Now remember, why is this important in finance? For be able to determine what a present value is of an asset compared with the future value of an asset. As an investor, I'm sure you're probably aware of that you would hope that the future value is a lot more than the present value. And as a finance officer or manager, you want to be concerned of what it's costing you now in an asset compared to what it might have as potential in the future. So that's why this is all very important. And it's all based on 3 things. The amount of time involved in the nature of the investment over how many years or periods, the interest rate of the cost or the return on that asset, and then the amount of money. For example, here's the present value of $500 compounded at 6% for 1 year. Notice the formula, future value, 0.06, 1 period, $500. You can calculate that in a calculator. You can also do it by hand. But that tells us that if I have $500 today and I invest it at 6%, I'll have $530 next year. Again, $500 for 2 periods at 6%, $561.80. Here's how I got that number. Notice here we have formulas, function in our spreadsheet, and up comes the insert function calculator. Again, formulas, function, I go to financial, and I look for future value, FV. Same thing on a calculator, FV, future value. I put in the current interest rate that investment is at. In this case, it's 6%, 0.06. Over 2 periods, number of periods. There's no payment. This is not an annuity or a series of payments. This is a one-shot deal. The future value is the present value is I have $500 today. So I type that in as minus 500. That's so I get a positive number in my answer, minus 500. I hit OK. If you have a calculator, you would just hit FV, future value, and I get $561.80. Now we go the other way. What's $500 in the future? Present value today. And this is called discounting. So if I have $500 in the future, its present value at 6% for 1 year, $471.70. If I have $500 in 2 years, discounted back to today's dollars at 6%, $445. Again, formulas, function, financial, but now I would look at the present value calculation, PV, because I'm determining its current value today. Again, interest rate 6%, number of periods 2, its future value is $500, that's minus 500, and hit OK, and we get 445. So that's the concept of present value. Periods, interest, principal over a period of time, either in the future or either today. And also that can also be highlighted if it's an annuity. Annuity is a series of payments over time. And that gives us to the point, this present value, into Chapter 5, determining the value of debt. One of the reasons why our economy has been doing so well the last 10 years is money has been cheap. When money is cheap, low interest rates, that means asset values remain high. Here's an example of that. I have a $1,000 face value bond. You all know what a bond is. It's a promise to pay in the future to an investor who's lent you the money. The coupon on this bond is 10% a year, but the bond is payable semi-annually. That means the interest rate or coupon rate per period is 5%. 2 payments a year, 5% equals 10. So that means the coupon on this bond is every 6 months you get 5% of $1,000 or $50. The maturity rate, in other words, it comes due in 8 years. So that means there's 16 periods remaining on the coupon payments of this bond, and at maturity you get your $1,000. But now what we're trying to do is, that's okay if you want to hang on to this bond for 8 years and get the payments, but what if I want to sell this bond in today's market? That number in the market rate is called the yield to maturity. In other words, if this bond would be released to the market today at their risk and the market conditions, it would not pay 10%, it would pay 8.5%. So in other words, the market has dropped in relationship to the coupon value of the original issue of this bond. Interest rates have gotten cheaper. What is the current value of this bond in the marketplace? Well, you determine the present value of the $1,000 that you'll get paid in 8 years, the present value of the $50 coupon payment you're going to be getting on this bond in a market of 8.5% today. That's an interest rate per period of 4.25%. That bond's current value in today's market has gone up to $1,085.80. Interest has gone down. The asset value of this bond has gone up. Here's how I calculated it. Again, formulas, function, financial, present value. We're determining the present value of this 10% bond in an 8.5% market. PV, the interest rate in the market per period now is 0.0425. That's 8.5% divided by 2 periods a year. 8 years remain with 2 periods a year. That's 16 periods. The payment on this bond is what? $50. And the future value is what you get back in 8 years, $1,000. You hit that? $1,085.80. In other words, if I would be buying this bond in the market, I'd have to pay it at a premium. $1,085.80 compared to the $1,000 face value. Why? I'm getting 8.5%. I'm getting 10% money, $50 a period in a lower market, 8.5%. That value is worth more. The asset has increased. fundamental concept of credit investing, interest rates and its value in the market. In stock, it's a little different. Here's a problem from Chapter 6, Problem 2. We're asked to determine the rate of return or the cost of equity. Chapter 6 is a little confusing because it talks about beta and risk and deviations, but all you have to do as a student in our class, again, we're going to be frying other fish in this class, this is just review, is the relationship of credit and risk to the price of the bond and what you're expected to return. And the typical calculation of that is the capital asset pricing model to determine the rate of return on equity in the risk of a particular company. In this case, the risk of the AA corporation is 0.8, that's their beta. The risk-free rate in the market, which is the risk for zero beta, risk-free, which the rate is 4%, and the expected market return, which is the stock market, which has an average beta of 1.0, and in this case, the rate of return is 12%. Every day in the real world, these rates change. The risk-free rate in the United States market is the 10-year United States Treasury note. Right now, it's currently about 1.8%. It changes every day. So what is the rate of return if we want to invest and own stock in a company with a beta of 0.8 in a market of 4% for risk-free and 12% for average beta? We use the capital asset pricing model. And in that, it takes the risk-free rate plus what is called the market premium. The market premium is the difference between the market return, in this case 12, and the risk-free rate, which is 4. The market premium then is 8%. That 8% is multiplied times the risk of the company's beta, 0.8. Do the arithmetic, 4% plus 8% times 0.8, 10.4%. In other words, based on the risk in the market, and that risk is calculated by a regression analysis standard deviation, which you do not have to worry about the calculation. You just have to understand what beta is. It's the risk of the company, historically speaking, over the last usually 4 years in relationship to the average in the market, and AA Corporation has been better, thus a lower beta, 0.8. That means the expected return is 10.4% that investors would expect to earn from that stock. And then you go ahead and buy the stock. Chapter 7. Stock has 3 values. Its book value when it's initially issued, its market value, like today's closing stock price, what the market thinks its value is, and then the intrinsic value or the true value. The true value is what the company tells us they're going to be doing in the next year. For example, problem 2. A company expects in the next year to pay a $1.50 dividend. The company has disclosed, every company has to do this, that they're going to have a 6% growth rate. And the investors have determined that they expect, due to the risk in the market, just like we just did in Chapter 6, that they expect a return of 13%. Well, the current stock value is to take that dividend and divide it by the difference between the expected return and the growth rate of the company. So $1.50 divided by 13% minus 6%, or 7%, $1.50 divided by 7%, meaning that the intrinsic value means that stock is worth $21.43 today. Now, in the market, it might be worth $25. Then it's considered in the market overvalued. The market has a higher rating, cost or price than what it's really worth. So the intrinsic value is a way of determining the current value of a stock today. In order to do that, you have to know its dividend plan for the next year. Companies disclose that. You have to know their current projected growth rate for the next year. Companies disclose that. And then you're going to have, you or the investor will have to calculate the 13%, which is based on our calculation here. What's the beta of the company? the current risk-free rate, the expected market return. You calculate that out and stick it in this equation. There you go, $21.43. The last concept in our review is it's the second problem out of Chapter 7, Problem 6. What is the value of a company? And very simply, the value of a company is the cash flow, in this case the free cash flow, and we'll talk more about free cash flow next week, the free cash flow of a company in relationship to its cost of capital, WACC. We'll talk more about that in the next couple of weeks. So let's say we have a company that has a current today, a free cash flow of $400,000. In other words, they're generating after operations $400,000 of available cash to the investors. Their company is growing at 5% and their weighted average cost of capital is 12%. The question of this problem is, what is the value of this company based on this information? What's the value of the assets that are generating this return at these costs? If I take 400,000 and increase it by the growth rate of 5%, I have a free cash flow in the coming year of $420,000. I divide that $420,000 by the difference between the WACC and the growth rate, which is 7%, I get $6 million. That's the current estimated valuation of this company at $6 million. The point I want to make in this example is that the cheaper the cost of capital, the greater the value. For example, let's say I make this, instead of a WACC of 12%, I say that the company's cost of money is lower, 10%. Watch what happens to my equation. $8.4 million. The value of the company goes up because the cost of the money is cheaper. Go back to the 12% rate, increase the cost, back to $6 million. That's why interest rates in the market are so important for companies. If they go down, their value of their business goes up. If they go up, vice versa. That's why people are so scared, and politicians are so scared of inflation. Money is more expensive, asset values go down. So those are some key definitions of valuating stock and assets, determining the expected return or the cost of equity for an investment, determining the present value of a a debt instrument, a bond, and to learn the basic concepts of future and present value. These are our key topics in review that we all should be aware of, and at the same time we'll be using these, we'll be using these in other problems and case studies and work going forward. So I'd like you to review these, give me an example of it in your discussion post due Sunday, and then once that's done, we'll start next week into financial statement analysis and see how companies use this capital, use this present and future value to help them make make them have maximum value, profits, cash flow, which means a successful company. And we'll go forward with that. So thanks everybody. Hope this helps. We'll see you all Monday with a new video and a new week. Any questions, no problems, let me know. Remember, next week we officially start our office hours schedule, Tuesday afternoons and Thursday afternoons from 1 to 3, and Thursday evenings 7 to 9 p.m. My office hours on WebEx, the link is in the WebEx folder in your Blackboard. Have a great weekend, everybody. We'll see you all on Monday. And Orange County class, I won't see you on Monday. It's Martin Luther King Day, as you all know. But I'll send you another video on Monday to talk about next week's work. Thanks, everybody. Until next time. Bye-bye.